Monetary policy is the second leg in the federal government's demand management policy. The government's demand management policy refers to the tools available to the federal government to smooth out the business cycle by affecting aggregate demand. The first leg that we discussed is fiscal policy. Fiscal policy refers to government taxing and spending. If the economy is experiencing a recessionary gap, for example, the government could run a budgetary deficit, injecting more spending into the economy, thereby shifting the aggregate demand curve to the right. Output would go up, and unemployment would go down. The price level, however, would rise. If the economy were experiencing an inflationary gap, on the other hand, the government could get the price level down by shifting the aggregate demand curve to the left. They could accomplish this by running a budgetary surplus. The price level would go down, but the level of output would also go down and the unemployment rate would go up. This seems straightforward enough, but there are some major problems with fiscal policy as an effective economic tool. First, when the government runs a budgetary deficit, it must do so by borrowing. Not only does it have to repay the debt, which now stands at a whopping $29 trillion, but they also must pay interest on that debt. As the public debt increases, the portion of the government's budget that goes to paying that interest also increases, leaving less money available for providing national defense and other public goods, maintaining infrastructure and many other important government activities. It was initially believed that a public debt created by a deficit in one year could be repaid by a budgetary surplus in the next. The public debt would never, hypothetically, get totally out of hand. But in reality, it hasn't worked out that way. Every year the government runs deficit after deficit. That's because all the politicians in Congress wish to reward their constituents with spending flowing into their district. But no one wants to pay for it, so they just borrow it. In other words, fiscal policy has become an ineffective macroeconomic tool because it's been hijacked by the politicians. It is, instead, a political tool designed to keep the incumbent congresspersons in office. In addition to this problem, another drawback of fiscal policy is its timing issues. That is, fiscal policy has been shown to be untimely in delivering the right solution to an existing macroeconomic problem in a timely manner. It is almost always late to the game, and delivers a solution to a problem that no longer exists, or has been superseded by a different problem. For example, the federal government may wish to implement expansionary fiscal policy, but by the time it takes effect, the economy may already be at full employment and experiencing inflation. There are three fundamental reasons for the untimeliness of fiscal policy. The first is a recognition lag. Gathering statistics about the macroeconomy is a time-consuming process. It is not unusual for the Bureau of Labor Statistics to announce that a recession began 6 months ago. A recession, of course, would call for an expansionary fiscal policy, but now, 6 months later, does the economy still need economic expansion, or would a budgetary deficit be counterproductive? On the other hand, just because the price of gasoline or the price of milk is going up, doesn't mean that the economy is experiencing inflation. We need to see what the BLS concludes regarding its computation of the CPI. This index will take into account a vast market basket of consumer goods and services. It is difficult to recognize a macroeconomic trend from its very beginnings. A second cause for the untimeliness of fiscal policy is an administrative lag. This refers to the speed with which a bill can actually get passed by Congress and ultimately be implemented. A law must first be passed by the House of Representatives, which has about 435 members. To get a majority in the House usually requires a lot of negotiations, with each member motivated to hold out until the bill includes special concessions for his constituents. Then, after it passes the House, it goes over to the Senate, and the same process ensues. Even after the dramatic slowing of the economy resulting from the 9/11 attacks, it still took 5 months for Congress to pass an economic stimulus bill. The third reason for the untimeliness of fiscal policy can be called an operational lag. This refers to the time it takes for the economy to respond, once the fiscal policy has been implemented. For an expansionary fiscal policy, the government must first spend the money, the firms must then respond by hiring people to produce the output to meet the increased demand. The households must then spend that income, and the process starts all over, as in a circular flow. On the other hand, a contractionary fiscal policy for fighting inflation must first take money from households and businesses by increasing taxes. They must respond by reducing spending. Firms must then respond by recognizing that there is a surplus of unsold inventory building up in their warehouses, and cut back on production, lay off workers and reduce prices in order to sell it. This is a long-term process and does not happen overnight. By the time the firms start laying off workers, it could be that the unemployment rate is high and the economy needs some fiscal stimulus rather than contraction. This would make the economic slowdown much worse. Basically, fiscal policy has, over the years, become an ineffectual tool for smoothing out the business cycle. But, it is a very effective political tool. Monetary policy, on the other hand, is not subject to these problems for the most part. Because the branch of government that decides on monetary policy, the Federal Reserve System, affectionately known as the Fed, can do so without the need of approval of Congress. Its decisions cannot be vetoed by the President. So it is, to a very large extent, apolitical. And while it is still subject to the recognition lag that plagues the decision makers in Congress, it avoids the administrative lag that result from trying to get 535 people to agree on something. Decisions at the Fed are made by 12 people, none of which are reliant on the votes of their constituents. Each is appointed to a 14-year term, so there is no political maneuvering. It is much easier to get 12 people, motivated strictly to improve the economy, to reach an agreement. Usually in one of their 2-day meetings held 8 times a year. Even more frequently if the economy is in dire need of action. In addition, the Fed's policies can be implemented overnight. In fact, because the economy is so driven by expectations of consumers and businesses, just a mere announcement of the results of a Fed meeting are sufficient to move an economy. If the Fed announces that they plan to stimulate the economy, people will start buying things now, before the stimulus drives up the prices of goods and services. That alone will shift the aggregate demand curve to the right. Or, if the Fed announces that they've agreed on a contractionary policy, households would expect the economy to slow. They might start saving for the coming rainy day when the job market would shrink, or they might hold off on purchases until the price level falls. Either way, both the administrative lag and operational lag are pretty much avoided by monetary policy. So far, monetary policy sounds pretty good when compared to fiscal policy. But does monetary policy have any shortcomings? To see this, you need to know more about how monetary policy works. Let's start by understanding the banking system in the United States. Imagine a tiny isolated island, somewhere in the South Pacific. The economy is very primitive and there are no banks. Suddenly, somebody gets the bright idea of opening a bank. Let's just sketch in a bank. There's the edifice with its thatched roof and walls of bamboo. But what's that underneath? That's a vault, dug underground, where the bank will keep the cash. Remember, a bank is simply an intermediary, a middleman, bringing together two people who can mutually benefit each other. Usually a buyer and a seller. But in this case, it's bringing together someone with an excess of cash that he'd like to put to work, and someone with a shortage of cash. In other words, the lender would like to rent his money out to someone and be paid for it. But he knows he must lend it to someone who will pay him back. He doesn't know anybody like that, and doesn't want the risk or the hassle of all the investigative research. The counterparty, the borrower, would like to have something now, rather than waiting until he saves up enough cash to buy it, and he'd be willing to pay for the temporary use of someone else's money. Recall from an earlier lesson what it is that makes the middleman so good at being an intermediary. He keeps an inventory. This hole under the ground is where this bank will keep its inventory. There's nothing there yet, but that will soon change. So, here comes a guy walking down the jungle path, and he spots this strange new establishment. He decides to poke his head in to see what's going on. The person inside tells him that this is a bank, and explains that a bank brings together a lender and a borrower, and stays in business by acquiring its inventory at a low price and lending it out at a higher price. Just like a retail store, we put a top hat on this guy to indicate that he's got some money, just like that little man in the Monopoly game. Let's say that he has $1,000 in cash. We don't actually know what they call their currency on this island, but it doesn't matter. We'll just call it dollars. The teller explains to him that the bank can acquire its inventory in two ways. One way would be just by paying for it. In other words, if the guy with the top hat deposited money into a savings account, the bank would pay him a certain annual rate, say 2% per year. The other way, the teller explains, would be to provide virtually free check clearing services. The guy says, "Free? That sounds good to me. But what is a check clearing service?" The teller explains that a check is merely a set of instructions telling the bank to take this amount of money out of this guy's pile and either hand it directly to this person or put it in her pile. The guy says, "You'll do this for free?" The teller then explains that there might be a small charge here or there. He might have to pay for the checks, for example. But if he is charged a fee, it would be much lower than the cost that the bank encounters when clearing the check. Why would the bank be willing to carry out this person's instructions and bear the majority of the cost of doing so? To acquire its inventory. There are two primary ways in which the bank can acquire its inventory. By providing depositors with checking and savings accounts. There are a couple of other ways we'll talk about when we learn a little bit more about the banking system. Let's suppose that top hat guy decides to open a checking account. He doesn't care so much about the 2%. But he would like to have immediate access to his money without having to carry it around in a jungle environment. So, he decides to deposit $800 into a checking account, leaving him with $200 in his pocket. The $800 goes into the vault. Wouldn't you know, just a little while later, a woman comes walking down that same path. She too is curious about this little hut, so she sticks her head in. The teller gives her the same explanation that she did to Top Hat Guy, and suddenly a light bulb in her brain switched on. As it turns out, she's had this secret dream of opening up a widget manufacturing firm for years, but never had the money to buy all the capital, the resources, hire some workers and rent out a factory. But now she says,
"Wow, a bank. Now I don't have to wait to save up the cash to open that widget factory."
So she steps inside and tells the loan officer that she'd like to borrow $800. The loan officer says, "I'm sorry, we only have $800 in the vault." The woman says, "But that's all I want." The loan officer then had to give her a lesson in the rules of the banking system. "You see," he said, "a bank is not permitted to loan out the entire amount of money in its vault. It must keep some on hand at all times. The total amount of money in the bank," he went on, "is called the total reserves. We are not permitted to lend out the total reserves. The amount that we must keep in the bank is called the required reserves. The remainder, called the excess reserves, represents the amount that we can actually lend out." So then she says,
"Well, how much can you actually lend me?"
He says, "Let me check on the reserve ratio. That is the proportion of total reserves, as set by the government, that must be held in the vault as required reserves. It looks like the reserve ratio is 20%. 20% of 800 is 160. So, that leaves us with $640 that we can lend you. She says.
I'll take it.
So, the $640 goes to the woman, leaving the bank with $160 in the vault. Here's a new guy that enters the picture. He's the one wearing a dunce cap. He sells Zerks. Top Hat guy has been wanting to buy a Zerk, and dunce cap offers to sell him one for $500. Top Hat guy doesn't have that much cash, but tells dunce cap that he'll write him a check. Of course, Top Hat has got to explain what a check is, and go through all that again. Top Hat guy says that this is a set of instructions, telling the bank to take money out of my account and hand it to you. If you present this to the teller, the bank will, on demand, hand you the money. That is why checking accounts are also called demand deposit accounts. You get your money, on demand, without having to wait for it or do anything else. Dunce cap guy is a little leery, but agrees to accept the check. There's the Zerk, going from dunce cap to Top Hat. And there's the check, going from Top Hat to dunce cap. Well, you can imagine what's going to happen next. Dunce cap is going to take that check to the bank and present it to the teller. But when the teller goes to the vault to get the $500, the teller finds that there's only $160 in the vault. On the very first day of business, this bank goes bankrupt. And, interestingly enough, this is exactly the way that the banking system works in modern developed capitalist nations. It's called the fractional reserve system. The term fractional refers to the fact only a fraction of depositors' money is in the vault at any given time. Does this make you leery of the banking system? Does this make you want to go to the bank immediately and get your money out while the getting's good? If everybody started doubting the banking system at the same time, they would all descend on their local banks to get their money out while there was still some left. Obviously, it would all be gone by the time the last depositors in line got to the teller. But as long as everybody is confident in the banking system, they're not going to make a run on the bank to get their money out. Every time I've tried to get my money out, there was always enough in the vault for me. As long as I'm confident in that, I'll keep my money in the bank and take advantage of their check clearing services, or the interest I receive on my savings account. But there have been situations in the United States where people have lost confidence that there will be enough there for them when they go to get their money out. During the Great Depression in the 1930s, the economy slowed dramatically. The unemployment rate reached 25%. Businesses were going bankrupt, borrowers were defaulting on loans, and no one was trusting the stability of the banking system. Under those circumstances, you would get to the bank as soon as possible in the hopes that there would still be some money left in the vault for you. This is a bank run in 1930. One of the factors that made the Great Depression so bad was that the banking system became illiquid, that is, they had no inventory, no money to lend. When you lose your savings, you stop spending. As a result, the economy continued to slow down even further. So, confidence in the banking system is key to the successful functioning of the fractional reserve system. As long as we are confident that there will be enough money in the bank when we go to get ours out, we will not be in a hurry to withdraw our money. In this situation on the island, there was only one depositor. But when there are many, it is unlikely that everybody would be trying to get their money out at the same time, unless of course there was a cataclysmic event like the crashing of the stock market in 1929, the 9/11 attacks in 2001, or the bursting of the housing bubble in 2008. To provide confidence in the banking system, the Federal Deposit Insurance Corporation was established in 1933 as part of Franklin D. Roosevelt's New Deal. The FDIC currently insures deposits in commercial banks up to $250,000. That is, even if your bank runs out of money in the vault, you'll still get your money back from the FDIC. Knowing that I'm going to get my money back one way or another gives me the confidence that the banking system needs. Now that we know a little about how the banking system works, let's talk about monetary policy. Monetary policy attempts to shift the aggregate demand curve to the right, to prevent the economy from slowing down too much, which would result in too much unemployment, or to the left to keep the economy from speeding up too much, which would result in too much inflation. As you know, an important determinant of aggregate demand is the interest rate. A bank will set the interest rate it charges a borrower based on the supply and demand for the cash in its vault. If the demand is higher than the supply, the bank will charge a higher interest rate. If the supply is higher than the demand, the bank will charge a lower interest rate. So, the government can influence interest rates that banks will charge borrowers by changing the supply of money in the vaults of the banks. Who is responsible for changing the supply of money? As you know, it is the Fed, the Federal Reserve System. The Fed is America's central bank. Let's see how the Fed changes the money supply to influence the direction of interest rates. The money supply is changed by changing the amount of loanable funds in the vaults of banks. An increase in the money supply leads to lower interest rates. A decrease in the money supply leads to higher rates. The Fed can change the supply of loanable funds in the vaults of commercial banks, that is, the money supply, in three ways. Actually, there's a fourth, but we'll just review the three most important. The first one we'll discuss is the discount rate. The Fed is a banker's bank. That is, the functions that a commercial bank performs for you are the same functions that the Fed performs for commercial banks, including lending them money. Why would a bank want to borrow money? Two reasons come immediately to mind. First, as you know, the bank must abide by the reserve requirement established by the Fed. That is, it must keep a certain percentage of its deposits on hand and in cash at all times. It can't close its doors for the day unless it has the appropriate amount of cash in its vault. If it's running short because the bank loaned out too much money that day, it can borrow from the Fed to meet its requirement. For the second reason, consider what a bank in a banking system might have done, had it faced the same situation as that individual bank on the island. When Dunce Cap Guy presented the $500 check to the teller could have quickly made a phone call to the Fed and borrowed the $360 it needed to pay Dunce Cap. There was no Fed, nor were there other banks to borrow from on that island, so the bank closed. Therefore, in a capitalist economy where there is a banking system, if a bank doesn't have enough reserves at the end of the day, or enough cash to pay its depositors, it can always borrow it from the Fed. But the Fed's going to charge them interest. The rate that the Fed charges a commercial bank for a loan is the discount rate. If the Fed lowers the discount rate, the commercial bank's cost of acquiring its inventory goes down, and this will allow the bank to lower interest rates to its customers. Or, if the Fed increases the discount rate, the commercial bank's cost of acquiring inventory will go up, and the bank will pass this cost increase onto its borrowers in the form of higher commercial interest rates. A second way that the Fed can change the supply of loanable funds in the vaults of commercial banks is by changing the reserve ratio. If the Fed increases that portion of the bank's total reserve that must be kept in the vault, the supply of loanable funds, the excess reserves that the bank can loan out, goes down. Obviously, if the Fed decreases the reserve ratio, the bank's supply of loanable funds goes up, even without any additional deposits. The third way in which the Fed can affect the supply of loanable funds in the vaults of commercial banks is through a process known as open market operations. Open market operations refers to the buying and selling of U.S. government bonds. Open market operations are used far more frequently than either changing the discount rate or the reserve requirement, in the Fed's attempt to fine-tune the economy. Let's see how open market operations work. Here's a commercial bank, and the Fed. Here's the bank's inventory of cash in the vault from depositors. This stack isn't money. It's comprised of bonds that it had previously bought from the United States Treasury. A significant portion of the bonds issued by Congress to finance the budgetary deficit are purchased by the Fed. And there they sit in the Fed's vault. This contraption is a printing press. For printing money. And here's the money being spewed out by the printing press. Now, suppose that the economy was heating up too much, and the Fed wanted to dampen inflationary pressures. It would then want to shift the aggregate demand curve to the left. This would be known as a contractionary monetary policy, because its intention is to contract or slow the economy. It would also be known as a tight money policy because it would mean that interest rates would go up and money was more expensive to borrow. The Fed's plan would be to sell the bonds to the banks. Rather than earn interest from borrowers, the banks could earn interest from these bonds it buys from the Fed. To pay for those bonds, the banks would use the cash in their vaults. If you wanted to borrow money from the bank, you'd have to pay a higher rate than those bonds were paying. There go the bonds from the Fed to the bank. And there goes the cash from the bank to the Fed. There are the bonds, now sitting in the bank's vault. And as you can see, the bank's supply of loanable funds has gone down. A lower supply of loanable funds would cause the bank to increase the interest rates it charges borrowers. Let's now see what would happen if the Fed wanted to implement an expansionary monetary policy, or a loose, or easy, money policy. This would cause the aggregate demand curve to shift to the right and the economy to speed up. First, the Fed would print money. Then, that money would be used to buy those bonds in the vaults of the commercial banks. Look at the bank's vault. The bonds are now gone, but there's more cash. With a higher supply of loanable funds, the banks lower their interest rates to borrowers. With lower interest rates, consumers and firms borrow more. The resulting increase in spending then shifts the aggregate demand curve to the right.